What do you think, first of all, about the real effects of the trade spat on oil demand?
I think it all comes through GDP activity. And at the end of the day, if GDP remains as strong as it is right now, oil demand will continue to be strong. We are eating very quickly through the OPEC spare capacity. We think we're already between 1 and 2 million barrels per day. We are going into a very, very tight oil market.
So we saw Saudi pull back on production a little bit. We know that Iran is going to fall out soon. Venezuela is having trouble getting anything out of the ground. Is the supply side really going to shrink, or can President Trump kind of jawbone or tweet the Saudis into keeping it up?
I think there's no doubt that we're heading into a slowing period of supply growth. Venezuela continues to decline 400 to 500,000 barrels per day. The hit on Iran could be up to 1 million barrels per day, depending on how some of the countries like China react. Libya is unpredictable. U.S. supply growth is constrained by infrastructure. So when we take it all together, I think there is substantial risk to supply. And this is actually still a period where a lot of major projects come on stream. The question is, what will happen in 2020, 2021, when on our analysis, the pace of new project startups slows down, and shale itself, we think, will start to slow down on the back of more decline rates.
I just want to point out, there's a great function, OPEC Go, on the Bloomberg, and if you click on this, you can see, Neera, that crude production has really come down. I mean, I'm used to always seeing crude production at an all-time high, but we've seen it pull back, and if it pulls back further, that could be a big problem for the price.
Yeah, and to that point, Michele, you've been saying that we've got a tight market approaching. What should big oil be doing right now in terms of spending to prepare for that?
Yeah, I think big oils are back into a position they last held in the 90s, which is effectively they are now the oligopolists of mega projects. Nobody else can finance big development. We think they're back to being the Seven Sisters of old. So I think what they can do is continue to use this stronger position to negotiate improved tax terms with governments, improved terms with the oil services, continue to simplify and standardize projects, and only sanction them when they can get mid-teen returns at the back end of the forward curve, which is about $5 to $10 below the spot, which means that spot prices in this new period of structural backwardation, they can go back to 15+% returns, something they haven't enjoyed on new projects since the early 2000s.
But should some of these companies actually be investing more or doing more deals to boost growth with the oil price where it is right now?
I think they should do more activity. That doesn't necessarily mean more money. I think they've learned how to simplify and break down projects in ways that make them profitable with much lower budgets. We ran a big report called Top Projects, where we look at all of the largest oil and gas developments in the world, and we estimate that the cost of deep water and LNG mega projects is down 60 to 70% from the peak. So as they substitute money spent at the top of the cost cycle with these simple projects, $1 is equivalent to $3 they were committing to in 2014.
Interesting.
Which big integrated oil companies do you think are in the strongest position right now?
I think, to be fair, the sector very much moves together. And I think big oils as a whole can enjoy today an oligopoly that gives them higher returns. So I think all of big oils re-emerges as an industrial winner like they were in the 1990s, like they were not in the 2000s. Like in the 2000s, the only bit of the oil and gas supply chain you wanted to own as an equity investor was oil services. Today, I think you want to own big oil like you wanted to own them in the 1990s, because we're back into what we call an age of restraint from a capex perspective.
But would you rather own the producers than the underlying commodity?
I think in both cases, the backwardation in the forward curve gives you advantages. In the commodity, you get the roll, which gives you an income. And on the equity side, you get a similar roll through a positive earnings revision as consensus estimates continue to revise upwards the oil forecast. So I think you want to own the commodity and the big oils in ages of restraint, as much as in ages of expansion like the 70s or the 2000s, you want to own oil services and smaller E&Ps.
Right, so you want to own the commodity and the big oils. Can I ask you about BP? I'm wondering whether you think they can deliver the production upside that they've promised from the BHP shale assets they agreed to buy last month.
So if we look, I think, at the industry as a whole, I think shale is clearly a key part of the future growth, and it will be a key part of big oil's portfolio. But I think the key point today is that areas like deep water, like heavy oil, like LNG, have actually become as profitable as shale thanks to the deflation in cost. And therefore, I think for every big oil, it's important to have actually a quite well-balanced portfolio with mega project development and the shale presence.